I bet you didn't know how one company could nearly bring the entire global economy to its knees. Welcome to Entrepreneurial Edge. Today, we're diving deep into the Great Recession and the pivotal role played by AIG. If you find this video insightful, don't forget to like and subscribe to our channel for more in-depth analyses. The year 2008 brought with it an economic earthquake that shook the globe. The tremors of this financial disaster were felt in every corner of the world, leaving no industry or individual untouched. Millions lost their jobs, their homes, and their life savings. The American dream turned into a nightmare for countless families as they faced the harsh reality of unemployment and foreclosure. The culprit? A perfect storm of risky financial practices, lax regulations, and a dangerous belief that the good times would last forever. Financial institutions had engaged in reckless behavior, making high-risk investments without fully understanding the potential consequences. At the heart of this storm was a giant American international group, better known as AIG. This behemoth of the insurance world had made massive bets on the housing market, and when the bubble burst, it found itself in deep trouble. The story of the 2008 financial crisis is complex, but one thing is clear. It wasn't just one company or one decision that brought the world to its knees. It was a culmination of years of unchecked greed, poor oversight, and a culture that prioritized short-term gains over long-term stability. Years of unchecked greed and a culture of excessive risk-taking had set the stage for disaster. Wall Street had become a playground for the wealthy, where fortunes were made and lost in the blink of an eye. Wall Street, fueled by the promise of quick profits, had ventured into uncharted territory, creating financial instruments so convoluted that even seasoned experts struggled to understand them. These complex products, like CDOs, were sold to investors who had little idea of the risks they were taking on. The housing market, long considered a safe haven for investment, had morphed into a bubble of epic proportions. Real estate prices skyrocketed, driven by speculative buying and selling. Fueled by low interest rates and lax lending standards, home prices soared to unsustainable heights. Banks and mortgage lenders offered loans to anyone with a pulse, often without verifying their ability to repay. People were buying homes they couldn't afford, enticed by exotic mortgages with low initial payments that would later balloon into unmanageable sums. These adjustable-rate mortgages, ARMs, seemed like a good deal at first, but they soon became financial traps. This house of cards, built on a foundation of debt and speculation, was destined to crumble. When the housing market finally collapsed, it triggered a chain reaction that brought the entire financial system to its knees. The consequences of this widespread recklessness were dire, impacting individuals, businesses, and entire nations. The ripple effects of the crisis were felt around the world, leading to a global recession that took years to recover from. The crisis exposed the interconnectedness of the global financial system, demonstrating how a problem in one corner of the market could quickly cascade into a worldwide catastrophe. No country was immune, and the economic pain was shared by all. The world watched in disbelief as the financial system teetered on the brink, a stark reminder of the fragility of even the most seemingly stable structures. The lessons of 2008 are clear. Unchecked greed and poor oversight can lead to disaster, and the consequences can be felt for generations. At the core of the crisis lay a seemingly innocuous concept: subprime mortgages. These were loans given to individuals who, under normal circumstances, would not qualify for traditional mortgages due to their poor credit histories and low credit scores. These loans, offered to borrowers with poor credit histories and low credit scores, promised the dream of homeownership to those who had previously been excluded from the market. It was a chance for many to finally own a piece of the American dream, a home to call their own. On the surface, it seemed like a noble pursuit, expanding access to the American dream. Families moved into new homes, children played in their own yards, and communities flourished. However, beneath the surface lurked a dangerous reality. The very foundation of these loans was unstable, and the risks were not fully understood by many of the borrowers. Lenders, eager to capitalize on the booming housing market, relaxed their lending standards to an alarming degree. They saw an opportunity to make quick profits and jumped at the chance, often ignoring the long-term consequences. Borrowers were approved for loans they could ill afford, enticed by adjustable-rate mortgages with low initial payments that would later skyrocket. Many were unaware of the financial trap they were stepping into. These mortgages, often bundled together and sold off as securities, were marketed as low-risk investments, despite the shaky financial footing of the borrowers. The complexity of these financial products masked the underlying risks. Wall Street, ever hungry for higher returns, embraced these mortgage-backed securities with open arms. The demand for these high-yield investments grew, fueling the cycle further. They were packaged, sliced, and diced into complex financial instruments known as collateralized debt obligations, or CDOs. These CDOs were then sold to investors, spreading the risk across the financial system. These CDOs, rated as safe investments by credit rating agencies, were sold to investors around the world, spreading the risk far and wide. The global financial system became intertwined with these risky mortgages. The problem was, these securities were only as good as the mortgages that backed them. As more and more borrowers defaulted, the true risk of these investments became apparent. As long as housing prices continued to rise, everyone seemed to win. Borrowers could refinance their mortgages, lenders could collect fees, and investors could enjoy healthy returns. It was a seemingly perfect system. Borrowers could refinance their mortgages, lenders could collect fees, and investors could enjoy healthy returns. The illusion of stability was maintained as long as the housing market kept booming. But this illusion of stability was built on a foundation of sand. The entire system was precarious, and it was only a matter of time before it all came crashing down. When the housing bubble inevitably burst, the consequences would be catastrophic. The dream of home ownership turned into a nightmare for many, and the ripple effects were felt across the global economy. While subprime mortgages and mortgage-backed securities played a significant role in the build-up to the Great Recession, another key player in this financial drama was AIG, the American International Group. AIG sold credit default swaps, or CDS, which were essentially insurance policies on CDOs, those complex financial instruments we discussed earlier. These swaps transformed risky bonds into seemingly safer investments by leveraging AIG's strong credit rating. Investors felt secure, believing that AIG's backing would protect them from potential losses. AIG's financial products division, based in London, generated massive revenue from these swaps. The division thrived in the high-stakes world of financial derivatives, making enormous profits from selling CDS to institutions around the globe. However, there was a critical flaw in their strategy. They failed to maintain enough reserves to cover potential losses. As the housing market began to show signs of distress, the underlying risks of these CDOs became apparent. Borrowers started defaulting on their loans, and the value of these mortgage-backed securities plummeted. The safe investments backed by AIG CDS were no longer safe. Suddenly, AIG was on the hook for billions of dollars in payouts. The company, which had appeared solid and stable, was now teetering on the edge of collapse. The financial system, already under strain, faced a new and dire threat. The U.S. government, fearing a total financial meltdown, stepped in to bail out AIG with an unprecedented $182 billion rescue package. This intervention was designed to stabilize the company and, by extension, the global financial system. The bailout was controversial, sparking debates about moral hazard and the role of government in the financial markets. However, it underscored the interconnectedness of the global economy and the far-reaching consequences of financial mismanagement. AIG's role in the crisis serves as a stark reminder of the dangers of unchecked risk-taking and the importance of maintaining adequate safeguards in the financial system. The fallout from their actions rippled across the world, contributing to the economic turmoil that defined the Great Recession. In summary, while subprime mortgages and risky financial products were key elements of the crisis, AIG's involvement through credit default swaps exacerbated the situation, leading to one of the largest government bailouts in U.S. history. The illusion of safety provided by AIG's strong credit rating masked the underlying vulnerabilities, ultimately contributing to the global financial collapse. When the housing market crashed in 2007, the subprime mortgages that had once seemed like golden opportunities began to default en masse. This cascade of defaults caused the values of CDOs to plummet. The financial instruments that were once seen as safe and profitable became toxic assets almost overnight. AIG, which had sold credit default swaps to back these CDOs, found itself in a precarious position. The company couldn't honor its commitments, leading to a massive shortfall. The ripple effect of AIG's failure spread quickly. contributing significantly to the downfall of Lehman Brothers and other financial institutions that were heavily invested in these so-called safe assets. On September 16, 2008, the financial world was shaken to its core when the U.S. government announced a bailout of AIG with an unprecedented $182 billion rescue package. The government deemed AIG too big to fail, fearing that its collapse would lead to a total meltdown of the global financial system. The bailout came with strings attached. The government took a controlling stake in AIG, replaced its leadership, and began a comprehensive restructuring of the company. This intervention marked a turning point in the crisis, highlighting the extreme measures needed to stabilize the financial system. The aftermath of the crisis saw significant regulatory changes aimed at preventing such a catastrophe from happening again. While the 2008 financial crisis left deep scars on the global economy, the story of AIG did not end in total despair. The massive $182 billion bailout that saved the company from collapse eventually turned out to be a profitable investment for the U.S. government. By 2012, AIG had fully repaid the bailout funds, and when the government sold its shares, it realized a return of $22 billion. This unexpected turnaround showed that even in dire situations, recovery is possible with the right interventions. The bailout and subsequent restructuring led AIG to downsize significantly, shedding non-core assets and refocusing its business strategy. By 2017, AIG had successfully exited the too big to fail list, marking a significant milestone in its recovery journey. This transformation was not just about survival, but also about learning from past mistakes and building a more resilient and focused organization. The story of AIG's recovery is a testament to the power of decisive action and the importance of systemic reforms. It also serves as a reminder that the interconnectedness of global financial markets requires vigilant oversight and responsible risk management. As we reflect on the impact of the 2008 financial crisis, it is crucial to recognize the progress made and the lessons learned. The changes implemented in the aftermath have strengthened the financial system, but the journey of vigilance and improvement continues. Despite AIG's central role in the 2008 financial crisis, it managed to avoid much of the public blame compared to banks like Lehman Brothers. This discrepancy in public perception can be attributed to several factors. Lehman Brothers became the face of the financial collapse largely because it was allowed to fail, causing a ripple effect throughout the global economy. In contrast, AIG received a massive bailout, which, while controversial, helped to stabilize the markets and avoid further immediate collapse. The narrative of AIG's recovery and repayment of the bailout funds also played a significant role in reshaping its public image. By 2012, AIG had fully repaid the $182 billion bailout, with the U.S. government realizing a return of $22 billion. This positive outcome helped to mitigate some of the public's anger and frustration. Moreover, AIG's restructuring efforts, including shedding non-core assets and refocusing its business strategy, demonstrated a commitment to change and responsibility. These actions were seen as steps towards redemption, unlike some other financial institutions that appeared less contrite. While AIG's involvement in the crisis cannot be overlooked, its path to recovery and the narrative surrounding it contributed to a more favorable public perception. This highlights the complexity of crisis management and the importance of both immediate action and long-term reform. Thank you for watching Entrepreneurial Edge. Please like and subscribe to our channel for more insightful content. See you in the next video.